Stock futures looking to recover some ground after Thursday's sell-off tipped the S&P 500 to its first correction since 2023. President Trump's escalating tariff policy has fanned fears of a broader economic slowdown. Our next guest says that while there's no doubt the economy has slowed from breakneck spending last year, a recession just isn't in the cards. Steve Risciuto, Mizuho America's chief economist, joins us now here. So Steve, just take us into your analysis right now. The big question over the course of this week is the recession, or is a recession, a base case, and how are you kind of evaluating what's played out within the slippage that we've seen in the equity market?
Yeah, no, I think you have to sit back and look at a broader perspective of the data. When you even look at the actual data itself, there's one or two weak pieces of data in a sea of much stronger and friendlier data. And we keep on excusing away the data that comes out that's on the positive side and saying, oh, that's going to change. Look at this one index that came out on the weak side. For example, the ISM manufacturing number or the last retail sales number. Those are really the only two pieces of weak data. Everything else that's come out since then, the JOLTS data and claims data, the payroll data, all have been on a much firmer perspective, even the upcoming auto sales numbers and the rebound expected in retail sales to be announced on Monday. All that we just say, oh, forget about it, because we have this recession concept in mind. And we're now basically have 8 recession calls since 2022, 3 so far this year, 5 in the previous 2 years. None of them have proven to be correct. And the reason for it is very, very simple. We are the largest, most leveraged nation in the world. We have exceptionally solid balance sheets. We have excess liquidity in the system. We have no systemic credit risks. We have an economy that can get buffeted around by shocks, and shocks will temporarily pull economic activity down. But in an environment where people have to produce double-digit returns, whether it's corporations or investment managers, you've got to find the next best alternative to go to grow your earnings and to grow the valuations for your investor clients.
So what do you make then of some of those warning signals that we're hearing from executives, not from investors who are freaking out right now about the lack of policy certainty from the Trump administration, but from Ed Bastian at Delta talking about the slowdown in consumer spending, from Verizon? Is that potentially a signal that we need to be concerned about?
No, I mean, when you think about it, the consumer is dealing with a 4.1% jobless rate. That's well below the natural rate of unemployment or the frictional level of unemployment. Wage gains are growing at 4.1%. Sure, consumers in an uncertain environment may very well sit back and say, oh, let me take a break. I just spent a hell of a lot of money in the fourth quarter of the year where consumer spending was up over 4%. Time to sit back and take a break. And yeah, as an executive sitting in the president's office in some of these companies seeing this, of course you signal, oh, this is a problem. Let me take down my earnings number. But all you do is set yourself up to exceed your earnings numbers going forward because it's early in the year. And in fact, we see a lot of this happen repeatedly in the beginning stages of each year. And CEOs aren't really necessarily the best indicators of actually where the economy is going to go. They're looking at what's happening in particular in terms of their particular sector. But again, when you look at the airline industry, they've raised prices a heck of a lot. And, maybe people are balking a little bit at their prices. Maybe it's more a margin story than it for these companies than it is a real demand story. And that's where we get confused signals sometimes. And that's where people misread recession forecasts that they shouldn't read in.
What about what CEOs are saying about the tariff story, Steve?
Look, tariffs add to a level of uncertainty. There's no doubt about that. But again, at the end of the day, you have to sit there and you have to grow your company. You have to produce double-digit earnings. There's no excuse not to produce that. You can sit here in the month of March and say, well, I can be uncertain about it. But by the time you get further and further into the year, you better have that performance, because you don't hit your shareholder value. Guess what? You aren't in that position for too long. So again, it's the incentive to drive shareholder value that really overwhelms the uncertainty from tariffs. And let's be honest, the more the uncertainty from tariffs lingers around, the less we begin to focus in on it and the more we begin to focus on other things that attract our attention.